Hello and welcome into the KE Report. Shad and Corey here as your host, and today we're getting an update from our friend and colleague Jordan Roy-Byrne. Jordan is the editor of the Daily Gold, and we will put a link down below so you can follow along with Jordan's analysis. Jordan, it's always great to get you on the show just to get your take on things. And when we look at the precious metal sector in a general sense, in the short term, we do seem to be getting overbought on a number of different factors. So maybe we can kind of lead into it with that mindset. But we're also going to share during the course of this discussion a chart that you have, some analog charts on what the longer term secular bull market could look like. But let's start off with the short term analysis on the overbought readings we're getting in gold and some of the mining stocks.
Sure, yeah. Well, I first noticed this about, let's say, 2 weeks ago or a week before last Friday. So going into the previous week, we were fully overbought on my breadth indicators. And what that means is I'm looking at the percentage of stocks, GDX, Huey, GDXJ that are trading above the 20-day, 50-day, and 200-day moving averages. And so a couple weeks ago, we were basically almost across the board, 100% of these stocks were trading above the 20 and 50-day moving averages. So when that happens, you typically get a correction. Now we got like a day or two of selling, and then last week we popped back up, even made slightly higher highs in some cases. But going into the weekend, when I do my comprehensive updates, I noticed, okay, we're basically GDXJ was, I don't remember the exact numbers, but it was basically percentage above the 20, 50, and 200 day. It was like 96%, 100%, 96%, 96%, something like that. Now looking at GDX and HUI, it was 100% across the board. So even with respect to the 200 day, we were near fully overbought. So when you get that overbought, the market almost always corrects. So I think the risk reward in the very short term is not bullish. I don't know how much we're going to correct or how long, and that doesn't mean every stock, because there's still stocks out there that are good values and they're marching to the beat of their own drum versus other stocks which have just gone through the roof and clearly need to correct or rest for a while. But for the sector at large, yeah, very short term, I would say, the path of least resistance is probably lower. I would not want to see a move higher here in the very short term. And I hope gold and silver at the same time. I mean, looking at gold technically, I would just love it if it consolidated for a month or two. I mean, it's bullish, but just get some more time, get some more consolidation in there. Would love to see that. Would love to see silver, come back and maybe come back to 36 and just rest for a little while. I mean, that would be perfect. Just setting up for a bigger move into the fall. But, we'll see how it plays out. It doesn't always happen how you draw it up.
Jordan, on that timing front, when I was reading over your stuff, it has been a couple weeks that you've been mentioning that 100% breadth in GDX, HUI, but those are typically some of the larger stocks. During that time, as those have been at 100%, those breadth indicators, we've really seen the juniors start to take off too. Those aren't within those sort of ETFs. What do you think about the timing of all that rotation of money, that while these stocks are staying at elevated levels, we've also seen that rotation of money down the food chain?
Well, that's a very good point, Corey. And this is something we talked about in the spring, how even though gold was really overbought and needed to correct, and it has, although it barely has over the last couple months, we talked about how a lot of money is going to be coming into the sector, and that typically after the first wave higher in a cyclical bull market, a real cyclical bull market in gold and silver, money really starts to come in, and it's kind of the sweet spot where even though gold could be correcting, more money is coming in, and it's coming into the areas that haven't moved as much, silver stocks, juniors. So that's why I was mentioning here, yes, the sector is fully overbought, but that's not the case for every individual company. It just is a side point. And this is why when you're looking at individual companies to invest in, every individual stock doesn't have to be an expression of macro. Like my macro is, okay, I think silver is going to make a huge move here. I got to buy a silver stock, or, oh no, the sector's fully overbought. I got to start selling out of my stocks. That's the wrong way to do it. Like every individual company, just think of it as its own company. It doesn't have to be a macro expression or an expression on the technical setup of the overall market. We're just saying, look, the overall market's really stretched right now, but you can certainly find pockets of value in some individual stocks that are marching to the beat of their own drum. And that's why, it's company specific. I mean, I have a junior silver index of just 10 juniors that I put together, and it's not necessarily my 10 favorite or I think the 10 best junior silver companies, but that thing is up, or as of last Thursday, that thing was up 83% in 2 months. So a lot of these silver stocks have shot through the roof already, anticipating this move in silver. So, those stocks are super overbought along with the larger stocks. But again, as you're pointing out, there's lots of juniors out there where they've just started moving and they're not as overbought as others. So again, this is why you have to take things on a company by company basis. And again, not to belabor the point, but as we move deeper and deeper into this bull market, you have to manage these things individually. You have to trim stocks that get super overbought and super overvalued, and then rotate that capital into things that haven't moved as much or are much better values right now and have better prospects over the next 12 months. So again, it's great to know and understand the setup in the sector at large, but put a lot more attention and weight on individual stocks, their values, their trends, their technicals.
Yeah, such a good point, Jordan. And it's really a stock picker's market and has been. And there's certain stocks with totally different fundamental dynamics driving them in a different way. If it's an exploration company, it may be based more around the drill news than it is what the gold price is or what the silver price is. So, such a good point to look at it company by company. You did weave silver into the discussion, though, in the silver stock. So, I just have to ask you, you've also been writing about silver. I know for a long time we've been waiting to see if it would punch up above that $35 resistance. Now it has. It's up in the high 36s as we speak. It's touched 37 recently a couple of times. What does that mean for silver as far as your technical outlook in the near term? It's been catching up with gold, but just like the stocks don't have to mirror the macro and gold, silver doesn't have to match gold either. So it's marching to the beat of its own drum. How are you looking at silver technically?
Well, it has broken above 35, and you have various measured upside targets that point to 41. And if you look at a monthly bar or candle chart of silver, you can see that after 35 and 50, 41, there's some resistance there on the monthly chart. So it aligns perfectly. So you have a measured upside target of 41 based on, if you're using daily closing prices, you have a ascending triangle pattern. If you're using intraday prices in the bar chart, you don't have an ascending triangle pattern, but you have kind of a sideways pattern that projects to about 40.50 to 40.75. So I think 41 is the next stop for silver, but I do think the stocks are correcting here. So again, I'd love to see silver come back and, retest 35, maybe even 34. I just would love to see that over the next month or two, along with gold going sideways. But we're coming up on the end of the month, but also the end of the quarter. And the all-time quarterly closing high for silver, I believe, is 37. So we'll see in a couple weeks if silver can mount a close above 38. I mean, that would be really bullish, but I wouldn't be dissuaded if it closed at 36 or even 35. Silver's in a really good position. I know we're going to talk about the historical analog charts for gold, but looking at the silver analog, when I'm looking at the 4 best cyclical bull moves, and I'm looking at the current one, that projects to a high of about, I think, 45 this year, and then that starts to take off. This is the average. Starts to take off in January of next year. So, but silver's in really good position, and I'm not worried about the short term either way. And it has a really good technical setup. And, I think the stocks have discounted a lot of the strength already, but this is still a big opportunity. I mean, so silver could be really fun over the next couple of years.
Jordan, I would say the whole precious metals complex is in a really good position. Yes, it can be overbought, but overbought is a good thing. That means that money's coming in. That means that stocks are performing. And quite frankly, we have seen that gold leading, majors then joining in, the higher quality companies joining in. And now we've seen this big rotation of money down into other precious metals, including silver and the smaller stocks. But then that does tie into that historical analog chart that you had, where the question is, where is the next driver then? Because quite frankly, with silver playing a little catch up, I realize it's not back to all time highs, but it has done pretty well. And the silver stocks have now done well. The next leg up for gold could be just the next bullish narrative for the whole precious metals cycle, because gold does really lead, I think, a lot of the precious metals moves. You shared a few gold market analog charts. We want to stick to the one that shows the next 2 years from where we're at. And gold, when you compare it to the moves it had in the 70s and then the one that started in 05, the breakout from 05, this current gold market move right in the middle of those two. It's playing right along with the average. So what does that mean for the next couple of years?
Well, it's damn bullish for the next couple of years, but let me just explain these charts a little bit. So if we're stepping back, gold has had three big breakouts. Like there's been clearly three major breakouts in gold. And that, of course, is 1972, which was a bit artificial, but not as much as people say, in my opinion. So you have that one, you have the one that happened in 2024. So those are the two biggest breakouts. They broke out from long bases to new all-time highs. A breakout to new all-time highs is always significant. Now, the breakout in 2005 was not to new all-time highs, but it was significant because it broke out of you could say it was sideways or a slightly downtrending line of about 23, 24 years. And so breaking above $500 an ounce was really significant at that point. So we've only had three, and for comparison, we can only use two. So we're looking at the 72 in 2005, and that's why the averages are so important. So the two average lines here, the higher one is just a pure average, 50-50 of those two breakouts. The second and lower line is an average, but I weighted the 72 one, of course, which was super explosive, 1/3, and I weighted the 2005 one 2/3. So I'm trying to take a more reasonable, less hyper bullish view with the second lower line there. But focusing on the next couple years, as you pointed out, what we clearly see is, to this point, this gold breakout that happened in March of 2024, that is doing a good job of following the averages at this point, or it's at least close to the averages. And if you look at these two averages, they come up to, I think, a peak of like potentially 4,500 over the coming months. Then they have what looks to be, maybe potentially like a 20% correction. Then you have another leg higher in 2026, which I think, depending on which one you look at, could take gold on the lower one close to 5,000. Now, there's a big discrepancy. I don't know if that's the right word, but there is a big difference between the two, because the 72 one, that before the mid-cycle cyclical bear market, that one got up to 9,200 on the scale, where the other one got up to about 4,900. So that is a pretty big difference between the two. And I think, again, I think the averages suit us very well. But I would say the breakout that we've had in the move so far is more similar to the one in 72. I don't think it'll be as strong, but I do think it's, because it broke out to new all-time highs, it's the start of a new secular bull market, that is more significant and more in line with what happened in the 70s.
Jordan, maybe just a quick clarification on when we do get the cyclical bear within the larger secular bull, maybe just describe what you're expecting as far as a percentage pullback based on those different analogs.
Well, this is really interesting because if you think of this is really simple. If you think about on the current scale, the 72 to 74 move, that got up to 9,000 before it had a 45% decline. Now, the other move peaked out again, 4,900, so much, much lower, and that corrected 30%. So it's going to be a function of where we reach, like from what point does the cyclical bear market begin? And I don't necessarily think it's 2 years away. Like it could be 3, 4 years away. I would bet on it being closer to that than only 2 years away, unless gold and silver just really shoot through the roof here in the next 2 years. But yeah, the cyclical bear, again, it's going to be a function of how overbought and how high the gold price gets. If it's at 8, 9, 10,000, then yeah, you're probably looking at something around 40%. But if it peaks out at, below 8,000, maybe 6, 7,000, you're not going to get a 50%er at that point. It's probably going to be closer to 30, 35%. So again, it's a function of how stretched the market really gets, based on how well it performs over the next couple of years.
But Jordan, you look at both of these analogs, and look, the one from 72 at this point really shoots higher, right? There is that discrepancy here, and the one from 05 more just consolidated some of these gains. Maybe to your point of being boring for a few months. It looks like if you go by that 05 analog, it could be pretty boring through the end of the year, even into next year. Which outcome do you prefer? And any downside levels that we should watch for that says, look, if gold does correct from here, if it does consolidate down to this level, that's where it could really take off from?
Yeah, I think as far as the potential downside, gold has put in really good support. I think at 3,100. So I know there's an investment bank, I think was calling for maybe even like 2,500 next year, which is just asinine in my opinion. Yeah, looking at the current price action, if this correction in gold were to continue as far as time and go sideways for more than a month or two, 3,100 is a level I would look at. And you could have the 200-day moving average catch up to it at that point. And that would not be a bearish thing. I mean, the longer we consolidated in gold, that could set the stage for a really strong move the next leg higher. I mean, you consolidate for another 2, 3, 4 months. That to me would set the stage for a move next year where you could, potentially target close to 5,000. Now, whether that happens or not, and we don't have much of a correction, and gold makes a move higher and it goes above 4,000. Either way, at some point next year, we're probably going to see like a 15 or 20% correction in gold. I'd probably say something closer to 20%. So I think that's, people are always worried about a correction. That's really the next big risk, is if we have another big leg higher into next year, the market gets really overbought. You're at 4,500, 4,700, 4,300, something like that. Then you're setting up where you're probably going to have a 20% decline at some point. As far as the analog that I prefer, I think the 70s, the 72 one is going to be a better fit, just because that came after a breakout to new all-time highs from a long base. And that's what happened in 2024. So I think that's going to be the best fit. And if you look at that blue line, what you can see is, yes, it trended higher significantly, but you had a lot of volatility on both sides. So I think that's something that from this point forward, gold, I do think gold is going to go crazy to the upside, but that's going to entail lots of corrections along the way. Think about this. So I'm looking at this. In 73, I think gold had a 29% decline. Then it legged higher. And before it made its final higher high in late 74, I think it corrected another 20%. So you had 29%, then 20%, and then 45% even after that. So I do see gold moving dramatically higher over the coming years, but there's going to be sharper corrections along the way. So I think people need to understand that and the risk. And again, that's why, I say buy, hold, and trim in a real bull market. But I think we're probably going to start doing a little bit more trimming into next year as if we're following that 70s path, then we're going to see more explosive moves, but also bigger moves on the downside. And so you do have to trim more in that environment.
Well, I think we'll wrap it up there for today, Jordan, but a great point on trimming the gains as they come in the year to come, especially if we get up to that 4,000, 4,500 level. I think it's a normal course of any market to have corrective moves, and I don't think anybody on the call listening would be that upset if gold went up to 4,000 or 4,500 before doing a correction, because we spent a decade waiting for it to get above $2,000. So to see it up above 3,000 and well in the mid threes right now, it's a nice picture for the precious metals complex. Silver doing well, the gold and silver stocks doing well. So we'll keep following along. And for those that want to follow along with Jordan's work, definitely click on the link below. It takes you over to the Daily Gold, where, if nothing else, get his free updates once a week to subscribers, where he lets you know that's where we got this chart from today. But if you really want to find out about the stocks that Jordan thinks have the most torque to the upside, subscribe to the Daily Gold, and you can find out what he's really looking at for the top performers. Jordan, always appreciate having you on the KE Report, and as always, looking forward to our next conversation.
My pleasure. Thank you for having me.